Let's continue with our discussion of The Corporation in the 21st Century by Sir John Kay. Today is the fifth part of our interpretation. Previously, we discussed how a company's core competitive advantage lies in collective knowledge. So why not just keep developing this advantage, benefiting society while earning economic rent? If only it were that simple. This is much like a young person entering society. Idealistic, capable, talented, and starting to reap rewards. But inevitably faced with challenges and temptations. In the second half of the 20th century, a prevailing trend among large U.S. corporations was financialization, becoming increasingly driven by financial statements. This process unfolded in two stages: shareholder value orientation and financial engineering. In this section, we'll explore that evolution. It may even offer insight into personal development. Let's rewind to the 1960s. At that time, American corporations were dominant. So powerful, in fact, that many grew alarmed. The civil rights and anti-Vietnam War movements were in full swing, and student protests were widespread. Individualism was on the rise, and many began questioning corporations. Your multinational oligarchs. Monopolies. Part of the military-industrial complex. With such influence, shouldn't companies take more social responsibility? Could they invest in public goods, promote environmental protection, offer training and jobs to the poor, help reduce inequality? Could they stop dealing with authoritarian regimes abroad? Amid this pressure, economist Milton Friedman published a now-famous article in the New York Times in 1970 titled, "The Social Responsibility of Business is to Increase Its Profits." His argument stood apart. Stop demanding companies do this or that. As long as they operate legally, generating profit is their contribution to society. He was essentially invoking the invisible hand of the market, a core tenet of capitalist logic. Friedman's article sparked a conservative wave that emphasized free markets. Think tanks like the Cato Institute emerged. This intellectual movement eventually solidified into what we now call neoliberalism. Neoliberal theory borrowed from Ronald Coase's transaction cost theory, i.e. companies exist because they lower internal transaction costs, and the Chicago School's principles. It redefined the company as a nexus of contracts. In short, neoliberalism reduced the company to an instrument for maximizing shareholder value. In the 1970s, America underwent major shifts. First, the oil crisis led to economic stagnation and the failure of interventionist policies, triggering a turn toward market reforms. Then came Reagan and Thatcher, pushing full neoliberal agendas in the US and UK. By the 1980s, globalization accelerated. Cheap consumer goods flooded the US market, improving quality of life. People were content and no longer took to the streets. Corporations, too, learned PR. Investing in charity and image campaigns. Public criticism of corporations weakened. In this social climate, belief in the idea that companies exist to serve shareholders grew stronger. But this idea is flawed. Do shareholders truly own the company? If you own Amazon stock, can you use Amazon's warehouses for free? Obviously not. If Amazon goes bankrupt, do you owe anyone money? No. Then why should Amazon exist solely to serve your interest? Sir John Kay points out that this notion, that shareholders own the company, is unique to the U.S. British law explicitly states that shareholders do not own company assets. They only have a limited claim to residual earnings. German law similarly mandates that management consider the interests of shareholders, employees, and other stakeholders, with the goal of creating sustainable value. In other words, modern companies increasingly resemble independent entities not truly owned by any individual. The idea that corporations must serve shareholders originates from a 1919 Michigan court case. Neoliberalism, you could say, is capitalism with American characteristics. The first stage of financialization was shareholder value orientation. Management's main task became raising the stock price. In theory, stock price reflects company health. But there's a short-term versus long-term conflict here. Stock price is inherently short-term. Why? Because the financial institutions helping you go public don't care about your future. They just want their fees. And your shareholders aren't patient long-term investors. They're institutions like pension funds and hedge funds that care about quarterly performance. Fund managers are assessed monthly or quarterly, and won't hold your stock for 15 years. They'll sell it the moment it yields a gain. So on Wall Street, serving shareholders really means serving short-term price movements. Under this logic, management doesn't focus on the company's long-term health. It focuses on juicing the stock price. Stock-based compensation further incentivizes this behavior. U.S. CEOs typically serve about 5 years, so they're unlikely to care about outcomes 10 years down the line. If your goal is short-term price bumps, there are easy tricks. The simplest? Cost-cutting. Some private equity funds buy undervalued, but sound companies, then apply financial optimization. Cut maintenance, lower service standards, lay off staff, slash long-term spending. Generate an attractive profit margin to boost valuation and sell the firm. Neoliberals believe stock prices reflect underlying fundamentals and future expectations. If that were true, then stock price equals performance equals win-win. But Sir John Kay notes that, history shows otherwise. Markets are far from efficient. Prices are driven by emotion, speculation, and bubbles. Not perfect information. Take Jack Welch at GE. He manipulated earnings for years to manage stock price. The price looked great under his leadership, but he simply kicked risks down the road until they exploded later. Neoliberals ignored such manipulation. Under their influence, more and more corporate leaders pursued short-term gains. From the 1990s, U.S. corporations moved from shareholder value to full financialization, treating the company itself as a financial instrument. Management realized they didn't even need to focus on the business. Financial maneuvers could raise the stock price. Mergers and acquisitions were a prime tactic, especially horizontal acquisitions of unrelated businesses. These deals enlarged the company, expanded executive power, and signaled financial strength, which markets like. Investment banks loved them too. Fees. But did such mergers work? History says. Usually not. Many large-scale acquisitions led to chaos and value loss. Another method. Divestiture. Break off a non-core but profitable unit to make the company leaner. In theory, this boosts focus and efficiency. Stock prices often respond well. But the firm is an organic whole, and breaking it up may hurt long-term health. Then there's the most common tactic, stock buybacks. With excess cash, companies could invest in R&D or new markets. But financialized management prefers buybacks. Reducing share count boosts EPS, and buybacks signal undervalued stock, thus driving up prices. But buybacks mean foregoing substantive business growth. Boeing is the perfect case. After acquiring McDonnell Douglas and eliminating U.S. competition, Boeing began massive stock buybacks. Management focused on metrics instead of engineering. Neglect of safety and R&D led to major quality failures and aviation disasters. By this stage, executives no longer cared about products, customers, or innovation. They cared about quarterly reports. Everything became a tool to support the stock price. As Marx might have said, this is alienation. How does a once great company, rich in unique capabilities and societal value, become just a financial tool? In my view, financialization is a form of socialization, which means mediocrity. Once you're tied directly to money, you lose uniqueness. You surrender your will to external metrics. You stop asking what's meaningful and start asking what gets approval. Let's use a student's story to illustrate. A student named Jack once loved learning for its own sake. He excelled in class and beyond. He was driven by true curiosity. Then he learned that college entrance depended on test scores. So he pivoted to test-taking strategy, drilling problem sets, chasing rankings. His goal shifted from genuine mastery to high scores. Just like companies that once aimed to serve society now chasing shareholder returns. This worked. For a while. Jack got into a top university. But there, competition only intensified. Some students published papers, others won competitions, built networks, or joined social ventures. Their resumes looked fantastic. Jack realized he needed measurable achievements, too. He began choosing everything. Research, clubs, contests. Based on what would look good on LinkedIn. Each action was resume optimized. This is corporate financialization. Until one day, Jack faced a real-world problem, and found he lacked real ability. He had been playing the system, not building true skill. He wasn't a talent, just a tool of external incentives. Ironically, the classmates who ignored metrics ended up achieving the most. Financialization and metric obsession are forms of instrumental rationality, driven by short-term stimuli. Wall Street can spin all it wants, but the core logic of business remains. A company's long-term success ultimately depends on irreplaceable core capabilities, not gimmicks like cost-cutting or stock buybacks. That's it for today's content. Thank you for watching, and I'll see you in the next video.
If you feel there is value in this, please like, subscribe to this channel, and leave your thoughts or suggestions in the comments section. Let's grow together and read more good books.